Mark adjusts his silk tie in the reflection of a skyscraper window, having just deposited a $60,000 bonus check that is already effectively gone. According to the American Bar Association, the average law school graduate enters the workforce with $165,000 in debt. But for a high flyer like Mark, that number is closer to $250,000, carrying a hidden interest weight that compounds faster than his billable hours. He believes his $280,000 salary is a shield, but the Bureau of Economic Analysis suggests that in high tax jurisdictions like Manhattan, the combined federal, state, and city tax bite, totaling nearly 45%, transforms his prestige into a treadmill. Mark didn't just buy a degree, he bought a permanent membership in a high overhead ecosystem where the cost of appearing successful acts as a structural tax on his soul. Across the city, Sarah sits in a modest office earning $75,000 as a public defender. On paper, she is losing. In reality, the ripple effect of her strategy is already quietly rewriting her future while Mark is still smiling at his bonus receipt. Let's open Simon's ledger. We are running a 15-year simulation. Mark, the elite corporate litigator, versus Sarah, the strategic government employee leveraging the Public Service Loan Forgiveness Program and the tax efficiency of a 457B plan. Before we run this simulation, drop a comment below. Would you rather have a high salary with high debt or a low salary with a guaranteed path to zero? Let's see if your answer changes by the end. Seriously, by year one, the financial undertow is already dragging Mark down. He is in the 37% federal tax bracket, and after his Manhattan residency tax, every dollar he earns is worth 55 cents. He spends $4,000 a month on a status apartment because his firm expects him to live near the office for 80-hour weeks. Sarah, however, uses the public service loan forgiveness path. Her monthly payments are capped at 10% of her discretionary income, meaning she pays $300 while Mark is hemorrhaging $5,000 a month in post-tax dollars just to keep his student loan interest from ballooning. Look, the lifestyle creep isn't a choice for Mark. It's a job requirement. He needs the $500 suits and the $10 coffees to survive the culture of private law. By year 5, the seesaw effect is undeniable. Mark receives a promotion to senior associate, but his success is a forensic illusion. His salary is now $350,000, yet his net worth is stagnant because the invisible math of interest and taxes is eating his raises. Sarah has been maxing out her 457B plan with pre-tax dollars, meaning her small salary is actually a leveraged tool for wealth. She qualifies for a specialized low-interest mortgage program for government employees, while Mark's high debt-to-income ratio makes him a risky borrower for anything other than a high-interest jumbo loan. Right, here's the thing. Mark feels like he's winning because he's at the top of the pyramid, but he's actually just the most productive asset on the bank's ledger. By year 10, the psychological toll is a line item Mark can no longer ignore. He has paid $450,000 toward his loans, but because of the way interest is front-loaded, his principal has barely moved. Sarah hits the 10-year mark in public service, and with a single administrative stroke, her remaining $250,000 in debt is wiped clean, tax-free. She is 34 years old with zero debt and a retirement account that has been compounding at 8% for a decade. By year 15, the accounting is brutal. Mark is burnt out, sitting on a fragile net worth of $650,000, most of which is tied up in a high-maintenance apartment he can't afford to leave. Sarah, despite never earning six figures, has a net worth of $1.2 million. She owns her time. Mark owns the right to work 80 hours a week just to service his liabilities. One version of the future owns an asset, the other owns a memory of a good decision that turned out to be a life sentence. Simon closes the book.